Assalamu alaikum to all of you and a very good morning. This is the final day for this practice to pass session. My name is Hamad Sarwar and I'm the facilitator of this session. Alhamdulillah, in 5 days we have covered topics, in 4 days in fact. We have covered topics consolidation in more detail. We have covered the company accounts topic. We have covered the cash flow topic. And today we are going to cover one of the most important area for paper F3, and it will be relevant in paper F7 as well. That will be ratios and interpretation along with international financial reporting standards. So let's start the session. Now the topic for today is the ratio analysis. Ratio analysis is a very important topic with respect to F3, then F2, then F5, then F7 financial reporting, and F9 that is financial management. So the analytical skill that we will learn in this chapter will be used in paper F2 financial, that is MA paper and FA paper, and it will be used in F5 exam PM, F7 FR, and F9 FM exams. So what is all about the ratios? The ratio is actually the tool through which we measure the performance of the business. And this performance analysis will be used by different stakeholders to make their decisions. The most important stakeholder is the shareholder, who uses this analysis to decide about the future decisions, whether they should increase their investment in the company or they should redeem their investment from the company. So they decide about the decision based on analysis. Similarly, the management uses these analysis to know about why the company is moving upward, what are the reasons for moving the company into the upward direction, or if the company is going in a downward direction, who is responsible and what are the factors. So when we measure the performance, it will be measured in different dimensions. The first one is for every company, the profitability. Second one is the liquidity of the business, the efficiency of the business, and the position of the business. In this area, we will measure the profitability of the business. In this area, we will be measuring the liquidity position of the business. So liquidity is all about the company's position to pay off its liabilities when it becomes due. So if the business is liquid, that means the company has got sufficient assets to pay off the liabilities on timely basis. Then efficiency is all about the fund management. working capital management. That includes debtors, creditors, and debtors, creditors, and stock. And position is all about the gearing position of the business. How much the company has is being geared, and the impact of the gearing over the business. So these are the areas in which we measure the performance of the business. So talking about the profitability, I want all of you to rank the companies. You have 4 companies, A, B, C, D. So you have to rank the company in the order from the strongest company to the weakest company. So which of the following is more reliable or the strongest company, and which of the following is the least reliable? Positive, positive. So the company A is having a good profitability and a good liquidity. Negative, negative, positive, negative, and negative, positive. So which of the following is the best company? So you have to rank into a 1, 2, 3, 4 from the strongest to the weakest company. So definitely the first position should be allocated to A, and the fourth position should be given to B. Then what about others? Which company should be on the second number? Okay. Well, the answer that we have received is C is third, D is second. C third, D second. So P stands for the profitability and L stands for the liquidity. So do remember this, that D it should be on the second position and C can be on the third position. So here we come to know this, that the profitability is less important as compared to the liquidity. So you have to be liquid business that is more important than the profitability, because your sustainability will depend on the liquidity of the business. So if your business is profitability, but you are not paying your liabilities on timely basis, then your business will be bankrupt. Is that clear? So I'm showing you two ratios of the profitability, you are required to tell me the formula for the first two. First one is the gross profit margin and the operating profit margins. Yes, the formula, very good. The formula for the gross profit margin will be gross profit upon sales. And formula for operating profit margin will be PBIT, profit before interest and tax, divided by sales. Profit before interest and tax is also called operating profits. Okay, changes in admin. Now this is the formula in which examiner might ask you in the examination to calculate the gross profit ratio of the 2 years or the operating profit of 2 years, and you have to tell the examiner the reason for the increase in the gross profit or reduction in the gross profit. So the increase in the gross profit will result might be because of increase in the selling price. If you increase the selling price, the gross profit will go up. Similarly, increase in the sales mix of high profit product. Then reduction in the purchase cost or the production cost. So these are the reasons for the increase in the gross profit. And if there's a reduction in the gross profit, the reasons will be on the opposite direction. Then if there is an increase in the operating profit, so you should know this, that operating profit will be derived from the gross profit. So all the reasons you discussed above can be the reason for the increase in the PBIT. Then it could be because of the expenses. If the expense of the business has reduced, then it will going to affect the PBIT. So is it good that the profit before interest and tax of the business is increasing because of the reduction in the expenses? Is it good or not? Is it good that the business has increased the profit before interest and tax by reducing its expenses? I want your answers. Yes or no? Yes. So my answer is it might be good. It might be good that the business has increased the operating profit, that is profit before interest and tax, by reduction in the expenses, because of the fact that some of the reduction in the expenses are good for the business and some of the reductions are not beneficial for the business for the long run. Like if you reduces the number of employees in the business, so definitely it will reduce the expenses and it will increase the profit. But in the longer run, if a workload of 100 employees is managed by 60 employees, then definitely these 60 employees will be demotivated and it will definitely do errors and they might not see a good prospects in the company in the longer run. So they might not be working with the full productivity and capacity. So in the longer run, it might not be good for the business. Similarly, if you reduce the marketing expense, selling and marketing expense of the business, so in the short run, it is good that it will increase the profit, but in the longer run, if your marketing budget is reduced and the selling budget is reduced, then it will affect your business sales in the future. The best example is the Pepsi company. Everybody knows about the Pepsi company all over the world, but still Pepsi company is doing its marketing on different locations because they knew it that out of sight means out of mind. So that are the factors you should consider in a shorter run or longer run. So longer runs impact will be used for the bigger papers like F5, F7, F1, F9. But in this paper, you only need to tell examiner what is the reason for the increase or decrease in the particular ratio. Now the second slide, we have two ratios, ROC and asset turnover. You are required to calculate. Tell me the formula for this. So for the ROC, the formula will be PBIT upon capital employed. Very good. And there is another formula for the ROC, that will be asset turnover into operating profit ratio. So these are the two formulas that we use. So ROCE has a direct relation with the asset turnover and operating profit. So that is the reason they are saying, okay, once there is a movement in the ROCE, the result could be due to the movement in the asset turnover or the movement in the operating profit margin. So if the ROCE is increasing, the one of the reason could be the increase in the asset turnover or the increase in the operating profit margin or both. Now keep this point in mind when you are doing to calculate the capital employed. The formula will be share capital plus reserves plus long-term loan. Share capital plus reserves plus long-term loan. Is it clear? Okay, when we talk about the reserves, that includes the share capital, share premium, revaluation reserve, retained earnings. In doing these calculations, do not use this formula, total asset minus current liability. Don't use this formula for this paper, F3 or FR, total asset minus current liability. You have to use this formula, share capital plus reserves to long-term loan. Now the second thing is asset turnover. As it says, the asset turnover means that what revenue we are generating through the use of assets. So it's all about how much capital employed is available in the business and what revenue we are generating from this. So the basic difference between the asset turnover, the formula is sales upon capital employed. You can see in both the situations, we have capital employed in the denominator. So always remember this point that we are measuring actually the performance of the numerator. So in ROC, we actually are measuring the performance of the business profitability in comparison with the capital we have employed in the business. And in this situation, we are measuring the sales. So my question is, in today's world, what is more important? Either the sales or the profitability. Do remember this point, in today's world, sales is more important than the profitability. And that is the reason you can see the success of giant retail stores. In today's world, you'll see a different giant retail stores, and that the reason for the success is actually sales. They charge low profits. Even in today's world, you can see there are a lot of brands who offers discounts on regular basis. So if the brands are offering discounts on different regular basis, because they all knew that sales, overall sales is more important. So the reason for the increase in the asset turnover will be increase in the revenue or decrease in the non-current assets. Or in fact, overall capital employed, reduction in the capital employed. So these are the factors on the basis of which the asset turnover increases or decreases. Now we have two other ratios, the current ratio and the quick ratio. So all of you are required to tell me the formula for these, current ratio and quick ratio. Very good. The formula is the current assets divided by current liabilities. Do remember this point, the ideal ratio for this is 1.822:1. And for the quick assets, the formula will be current assets minus stock divided by current liability. The formula ideal will be 1.1:1 or 0.8:1. So what are the reasons for the increase or decrease? Increase or decrease in the current assets. So assuming there is an increase in the current ratio, the reason will be the increase in the cash balance or increase in inventory or increase in receivables or reduction in the payables. So if the current quick ratio is increasing over the period, so one of the reason could be the increase in the cash balance. But why may this have happened? Why the company's cash balance is increasing? So the answer might be the company has borrowed some funds. The answer could be the debtor has paid on time, or the increase in the cash balance due to the we are paying the creditors late, or this year we have bought almost all the inventories on credit. So these are the reasons on the basis of which we can say that there is an increase in the cash balance. And why there is an increase in the inventory? Why there is an increase in inventory? So it might be bulk purchasing. It might be some artificial effect like we do have in the COVID, that the companies which are producing masks and gloves will definitely have large number of stock as compared to the previously they had. Increase or decrease in the receivables. The increase in the receivables could be due to when why the receivables has increased over the period. When you increase the credit period of the customers, when you have more customers on which you sold the goods on credit, when the customer is delaying in the payments. So these are the reasons for the increase in the receivables. Similar for the payables. But do remember this, if the overall current ratio and quick ratios has increased substantially, then it would be misuse of resources. Or reduced substantially, then it will be the liquidity problem. It shows a liquidity problem. I hope you have understand this point. Now inventory turnover in days. All of you are required to write the formula for this one. Inventory turnover in days. Yes, the formula for the inventory turnover will be inventory upon multiplied by 365. Very good. And if the examiner asks you to calculate the inventory turnover in times, the formula will be cost of goods sold divided by inventory. Answer will come in times. Is it clear? Formula? Now the question is, should we use the closing or the average inventory? So remember this point that we always use the closing stock. And if you will not get the right answer using the closing stock, then you can go for the average stock. But first preference should be given to the closing stock. The formula for the average stock will be opening plus closing divided by 2. Is it clear? So if the question says you that the inventory turnover in days is 30 days or the inventory turnover in days is 40 days. So what does it means? If the inventory turnover in days of the business has increased from 30 to 40 days, then what does it means? It means that the company is selling the stock previously after 30 days from the warehouse. Now it's taking almost 40 days. So there's an increase in the 10 days that the stock will be held in the warehouse. So is it good for the company or it's a negative point? It's negative, yes, definitely, because when the inventory hold for a longer period, there will be a risk of obsolete inventory. There will be increase in the holding cost of the business. So there are a lot of negative points attached with the holding inventory for a longer period. So it's better that inventory should be sold on a timely basis. So the reasons: improvement and deterioration in inventory control, obsolete inventory, increase inventory level to facilitate marketing and selling campaigns. I hope it's clear. Now write the formula for the receivables collection period. Very good. Receivables divided by credit sales multiplied by 365. That's the formula. Same situation, first use the closing receivables shown on the balance sheet. If you will not get the right answer, then you can use the average receivable as well. So if the receivable period has increased from 30 to 40 days, what does it mean? Debtors are taking longer to pay. That's great. Debtors are paying us late. So there might be some positive points in it when we increase the credit period. That could be one of the reason, but there might be some negative point in it. One of the negative point that is will be the deterioration in the credit control department. Increase in the debtors is also one of the reason for the bad debts in the future. So these are the points that normally the examiner will ask. Similarly, the payables period, payables divided by cost of goods sold or credit purchases, whichever is given to you, multiply by 365. This will be the formula in days. If you wanted to convert the formula into times, you have to reverse that formula divided by payables and remove 365 in it. You will get the answer in times. Reasons could be new credit arrangements, new supplier, higher days may indicate inability to pay. Increased payment period may give an entity a reputation as a poor payer. If the company is paying early, then there might be a reason for a discount. In times shows that how many times in a year that we pay the creditors. In days shows that after how many days we pay the creditor. Now, then we calculate the working capital cycle. Inventory turnover in days, receivable days minus payable turnover in days. We got the value of working capital cycle. So the overall basis, the working capital cycle should be reduced. So if there is a reduction in the working capital on overall basis, then it means that the company is managing its finances efficiently. Or if there is an increase in the working capital, that it means the company is not managing the business efficiently. So it's all about the efficiency of the business or the fund management. Then we do in times, do we multiply into 165? No, we only multiply with the 365 when you are calculating in days. Now, please write the formula for the gearing. Now for the gearing, we use the formula debt upon equity or debt upon debt plus equity. Multiply by 100. So debt upon equity is also called debt equity ratio or equity gearing, and this one is called capital gearing. Now that includes all long-term borrowings with redeemable preference shares. Equity includes all time elements of equity, share capital, reserves, irredeemable preference shares, non-controlling interest if we are calculating for the group. Now, what does high gearing means? High gearing means large proportion of fixed return capital. Then you have to pay a fixed cost, that is interest cost fixed. Greater risk of insolvency and greater risk for the shareholders for the non-payment of the dividend, because most of the profit will be distributed with the name of interest, so there will be very limited profit available for the shareholders. Proportionally greater returns to the shareholders if the profits are growing. Yes, if the profit is increasing substantially, then you knew it that there is a fixed proportion for the shareholders and loan providers, and the remaining will be for the shareholders. Low gearing means scope to increase the borrowings for potential new projects, borrowing more easily perceived as lower risk. Is that clear? Do you guys wanted to ask anything? Is it clear? Okay, which one is good, higher gearing or low gearing? It depends on the profitability of the business. If you know that your profitability is going in a downward direction or you earn a very limited profit, then it's good for you to go for low gearing approach. But if your profit is increasing day by day with an upward trend, then it's good if you have got high gearing, because when you have high gearing, that it means that you have fixed cost. So you only have to pay the interest and the rest of the profit will be available for the shareholders. So gearing depends on the business, gearing depends on the position of the business and its future prospects. So the reason for the increase in the increase in gearing could be the increased issue of loan notes, because when there's an increase in the numerator, there will be an increase in the gearing. Trading losses, reduction in the retained earnings, which will impact on the denominator. So the formula for the gearing debt equity ratio is debt upon equity. So if the debt will increase, the gearing will increase. But if you wanted to increase the gearing, there must be the reduction in the equity. So there might be two possible reasons for the increase in gearing. The first one is the increase in the debt. The second one is the reduction in the equity. Okay. Then we have excessive dividend paid, repayment of the loan notes, trading profits increases the retained earnings, evaluation. So these are the factors for the reduced gearing. One, two, three. And these are the three factors for the increase in the gearing. Please read all these points and ask if you have any confusion in it. What does the gearing ratio actually measure? Gearing ratio actually, whenever you wanted to know about any ratio, just see the numerator of that ratio. So whatever we have in the numerator, we are measuring actually the performance of that numerator. So in the gearing ratio, we are actually measuring the level of debt that the business have in relation to the equity. Okay. Any question? What relation gearing to the position? Gearing is actually tells us the position about the business equity side and the liability side. So position means what assets you have, what liabilities you have, and what equity that you have. So in relation to the position, we are measuring the liability component. So as we all know that asset is equals to capital plus liability. So this is called the position of the business. So what is the proportion of the liability in relation to the capital? This is gearing. Interest cover formula will be PBIT upon interest expense. Answer will be in times. The higher the interest cover, the more uh, the business will be on the safer side. Used by the lender to assess the risk of the default. The risk of the default will be high when there is a low interest cover. Lender may insist on a maintenance of minimum interest cover as a part of the loan agreement. So this could be one of the requirement to maintain a certain level of interest cover. I hope it's clear now. So I'm giving you just 5 minutes. Please open the practice handout area, handout section, and download the ratio practice handout and do solve this question from 64 to question number 70. Question number 64 to 70. So you have to attempt 6 MCQs and you have 5 minutes to attempt it. Please try to start it. I'm giving you just 5 minutes to solve these 6 questions. Starting from question number 64 to question number 70. Is it done? Now please reconcile your answers and discuss with me if you have any issue in it. '64 is having A answer, 65A, 66A, 67C, 68C, 69 and 70 both having A answer. Is it clear to all of you guys? Profit before interest and tax, yes. Actually, it has different formulas. So usually we calculate the ROC based on the profit before interest and tax, but if the question specifically says you to use the profit before tax, then you can go for it. So these are the answers. I'm telling you the answers. 64A. Okay, in question number 64, it is telling you about the calculate the return on equity. It's not return on capital employed. It's return on equity. So when we talk about the return on equity, it will take in the numerator the profit after tax, because this profit will be available for the shareholders. Then and in the denominator will have to report the equity. So 64A, 65A, 66A, 67C, 68C, 69 and 70 both having A answer. So these are the questions. Example 1, these are your assignments. All of you are required to solve these questions at home, in which you are required to calculate the profitability ratios. Example 2 is related to the equity. And then example 3. So these are the 3 examples that all of you are required to solve it at home. This is your assignment. In the example 1, you have to calculate all the ratios related to the profitability. Example 2 is related to the liquidity and working capital. This is your home assignment. And example 3 is about gearing and interest cover. I hope it's clear now. So let's start the new topic, that is International Financial Reporting Standards, in which one of the most important standard is IAS 38. So are you guys ready for this, or you need a break first? I think IAS 38. So you are going to solve IAS 38, 37, IAS 10 and IFRS 15 today. Break? Okay. So then let's take a break of 10 minutes. We will start at 12:30. It's 12:20 right now. We'll start a session at 12:30. Okay, welcome back again. Let's start the session. So, are you guys ready to? Should I start right now? Are you ready? Okay. International Accounting Standard 38. IS 38 is about the intangible assets. It says you cannot recognize internally generated intangible assets. You cannot recognize internally generated intangible assets. Only purchased intangible asset can be recognized. Then this standard talk about the research and development area. Research means study to gain knowledge. Development means application of the knowledge. To manufacture a product or a service. So development phase is the application of knowledge to manufacture a product or service, and research means study to gain knowledge. So first of all, you should know clearly the difference between the research and development area. Okay. Internal generate means self-created, like goodwill. So every business think that it has a goodwill, but you cannot recognize that goodwill on the face of the balance sheet. You can only recognize purchase goodwill on the face of the balance sheet. Like if I have acquired a brand or a business, then I can recognize the brand value or the business goodwill only if I have got purchased that brand or goodwill. But if I have created self-created my brand name, like we can take the example of Apple. Apple is a brand or its business definitely will have some goodwill, but you cannot see a single asset with the name of brand name or goodwill on the balance sheet of Apple company because the goodwill and the brand name is just self-created thing. But if someone has purchased the value of the Apple company or brand of the Apple company's products, then they can recognize the goodwill or the brand name. So only if you have purchased something, then you can recognize that asset. But if you have created by your own self, then you cannot recognize that asset. Okay, what about the research and development? Research means study. So according to accounting, its amount should be charged in the income statement as an expense. Then development is the application of the knowledge to manufacture a product or a service. Now, development cost can be capitalized as a non-current asset, or it must be charged as an expense. So depends on what? Depends on the criteria. So standard has developed a criteria. So if that criteria is met, then you can capitalize development cost. Otherwise, it should be charged as an expense. So development cost. So what are the criteria? So whatever product or service you are developing, if it is cost efficient, if it will give you the profits in the future, and you think that development will be completed in the future, and you will get the returns from that development, and the management is committed for the plan, then you can say that development cost should be capitalized. So the most important criteria is whether we are going to get the benefit from that development or not. If you are making something and we are not getting that benefit that we are expecting from that product, like if we have developed something which will be a loss making unit, then accounting says that it will be charged as an expense. So if the criteria are met, means it will give you the future benefits, then it should be capitalized as a non-current asset, development cost. If the criteria are not met, then it should be charged as an expense in the income statement. Now, all intangible assets must be amortized over its useful life. And all intangible assets having unlimited useful life should be checked for impairment annually. Only assets with the limited useful life should be amortized. Is it clear? Is it clear to all of you? what is impairment? Impairment means that we have to see whether there is a loss in the value of the asset or not. So if there is a loss in the value of the asset, then it could be recognized as an impairment loss. So let's try a question. Now, this is one is a question for you guys. Just read it very carefully and apply your answers. Explain whether each of the items explained meet the criteria to be recognized as intangible asset. Whether the criteria are intangible asset, meets the criteria of an intangible asset or not. Assalamu alaikum. Okay, let's solve it. Initial investigation work to develop a new chemical compound which would disintegrate plastic 30,000. The result of the work to date, although promising, are inconclusive. Platinum intends to continue this investigation work. Now, see the meaning of the whole scenario. It says that there is actually a research work which is going on, and it's actually investigating about the new chemical compound. So it is actually a research work which is going on here. So all research costs should be charged as an expense. So answer for this one will be, as it is a research project, then it should be recognized as an expense. The second one, purchase a license. License is an intangible asset. Purchase a license to manufacture a hand tool. For unique design features, 50,000. The long-term license term is for 5 years, commencing 1st October. Now the answer for this question will be 50,000 should be capitalized and it should be amortized over 5 years. And the amount charged in the income statement will be 50,000 divided by 5 years into October, November, December. Because we have acquired the intangible asset in the month of October, so you only need to charge the amortization for the 3 months. That's October, November, December. So 50,000 divided by 5 into 3 by 12. Creation of a new material which will make the wetsuits of deep sea divers luminous underwater. 80,000. Of this, 20,000 relates to the material testing. Following the material testing, the project was regarded as technically feasible and commercially viable, with the Platinum committed to devoting sufficient resources to progress the things. Now, what will be the answer for this one, third one? Can you give you an answer? Simply, this question will be asked in MCQ style, so you don't need to worry about it. Simply, you need to see whether it will be capitalized or not. So 20,000 relates to the material testing. Testing cost will be recognized as an expense, and 60,000 will be amortized. Now, just see the solutions for these 3 questions. So the non-current asset will be recognized at 60, and the 20 will be recognized as an expense. Now these are the 3 questions. All intangible assets must be amortized. Is it true or false? No, because I have said already that all intangible assets having a limited useful life should be amortized. And the entity can choose whether or not to capitalize the cost of the research activity. The answer is no, it's false, because all research costs should be charged as an expense. You cannot capitalize the research cost. Intangible assets are classified as non-current asset as current asset. Sorry. intangible assets will be recognized as a non-current asset. So all these three statements are false. The examiner can ask you the questions like this in the examination, and I hope you are getting this standard. So if you have any question in your mind, please do ask it immediately. Otherwise, we are moving towards the next standard, that is IS 37. If you think that you have no issues, just write no in the chat box so that we can start the next session, next standard. Okay, IS 37. IS 37 is about the provisions. Provision is actually a liability of uncertain amount or time. Provision is a liability of uncertain amount or time. Okay. So provision is a liability of uncertain amount of time. So we recognize the provision by writing off an accounting entry of income statement debit and provision credit. So first you need to understand that provision is not a normal liability. There must be some uncertainty in the amount or the time period of the liability, then it will be called as provision. Like loan is a liability, but you cannot say it is a provision, it as a provision, because when we borrow the loan, we know the amount, exact amount that we should have to repay. Secondly, when you borrowed the loan, you know the exact time period after which that you have to repay the amount. So you know the time period, you know the amount, so it's a liability, but it's not a provision. In order to become a liability into provision, it must have some uncertainty. Okay, the accounting entry for the provision will be income statement debit and provision credit. Income statement debit means expense will increase, hence the profit will be reduced by this accounting entry. And provision will be created by liability increase. Now IS 37 says that you cannot recognize this accounting entry unless the criteria are met. So there are three criteria that should have to be met in order to recognize this accounting entry. The first one is there must be a present obligation arises from the past event. Outflow of economic benefit is probable. The amount can be measured reliably. There must be a present obligation arising from the past event. So when all these criteria are met, then we recognize the provision. If any of the point is missing, then this information will be disclosed in notes. This is called a contingent liability. Contingent liability. CL, I've mentioned the word CL, it's not current liability. That means contingent liability. The provision will be recognized only when the criteria are met. Criteria are there must be present obligation arises from the past event, outflow of economic benefit is probable, and the amount can be measured reliably. Is it clear? Reliably measurable. Amount can be reliably measurable. Now provision. Now this is the very important table for the provision account. When we talk about the contingent liabilities, there might be four situations: possible, probable, virtually certain, probable, possible, and remote, and having different percentages. These are the chances for the making a payment or receipt of the payment. So provision will only be recognized in the first two scenarios when the chance of the payment is virtually certain or probable minimum. And the information must be disclosed if the chance of the payment is possible. Mean the chances of the making the payment is between 5% to 50%. And if the chances is remote, then you don't need to make any even provision or disclosure. Similarly, for contingent assets, when you are going to receive the payments from the customers, so you can only recognize the asset when the chance of the payment is virtually certain. In the case of probable case, you can disclose the asset, and in case of possible and remote, you don't need to make any accounting entry or disclosure. So when you talk about the disclosure, that means the information should be written down in the is it clear to all of you? So if the answer is clear, please do attempt this question. Okay, that's not. Wait, let me take out the question for this one. Just read this one, this paragraph. Read this one and reply your answers. Now, judgment was issued shortly after the reporting date in respect of the legal action brought against the entity for the breach of a contract. As a result, the entity has ordered to pay the cost and damages totaling 50,000. No provision had been made for this possible expense. The breach of the contract occurred before the statement of financial position. Thus, the company required to make the accounting entry. Not. Do we need to recognize the provision? Yes, we should have to recognize the provision because the company is liable to make the payments. There is a present obligation arising from the past event, outflow of economic benefit is probable, and the amount can be measured reliably. So these are the all points that are met. Therefore, we have to recognize a provision. Is it done? Okay, should we move forward? Yes. Now the next accounting standard is IFRS 15. Now, here is the concept of IFRS 15. It says about the revenues, when to record revenue, and to what extent we should recognize the revenue. That is the discussion mentioned in IFRS 15. So IFRS 15 says first you need to identify the contract. First you need to identify the contract, whether there is a contract exist between the buyer and the supplier or not, and at what terms we have agreed on a contract. So IFRS 15 says that for all the cases of the revenue, you only need to follow the 5 steps. So suppose we are taking an example of an airline company. So in order to evaluate the revenue of an airline company, first you need to see the contract, whether there is a contract between the customer and the airline or not. So if there is a contract, then you are bound to receive the amount and you can recognize the revenue according to the provisions of IFRS 15. The second step is to identify the separate performance obligation. Let's take a live example for this. Do you guys have Emirates? Booking? That's Emirates. Now, accept, okay. So the airline will always ask you about where you wanted to go and whether that's a website of the airline, whether your tour is one way or two way. So if your tour is one way, like you wanted to go from Pakistan to London, Karachi to London, so there will be only one performance obligation in the contract. But if you say that I wanted to go to London on the 15th of February and will come back after 1 month from London to Karachi, then the airline will be having 2 separate performance obligations. So for all the performance obligations, you have to identify how many performance obligations are available in the contract. So step 1 is to identify the contract. The second thing is you have to identify the performance obligation. Now, the third thing is you need to determine the transaction price. If you book a flight on a website of any airline business, you will see the prices will be changing when you change the time, when you change the traveling, in fact, the time and the days. And if you say that I wanted to go one way, the price will be different. And if you say that I wanted to take the flight from two way, so the price will be different. And if you add multiple destinations, that my plan is to go from Karachi to Turkey first, then after a few days I will go to the Europe, then after a few days I will go to UK, Then after a few days, then I will go to America and then USA, then Japan, then China. So if you add multiple destinations, the transaction price will be different. So the third step is to determine the transaction price of the contract. Fourth step is to allocate the transaction price into different performance obligations. Like airline has taken a revenue, suppose, I think I should write something here in order to suppose if I booked an airline from Karachi to London, and then after a few days from London to Karachi back. Suppose airline has quoted a price of 3 lakh rupees for this ticket, and I have paid the whole amount in advance. So what do you think the accounting entry should airline business should have to make at the start? Today is 6th of February and I have to travel on 15th Feb, Karachi to London, and will come back on 28th Feb. So on 6th of February, I have booked the ticket online and I have paid the whole amount through the credit or debit card. So what do you think that Emirates Airlines should book the accounting entry in their books for this 300,000? What accounting entry you think that Emirates should have to book in their books of accounts? No, you cannot recognize the sales because you haven't provided any service. That's the key concept of IFRS 15. So right now you can only recognize bank debit 3 lakhs and you can recognize the deferred income 3 lakhs. Deferred income is also called unearned income. This is your unearned income which should be recognized as a liability of the business. Because suppose if I have booked the tickets on 6th of February and after a few days I feel that I don't need to go because of the COVID situation, then airline is bound to return my full amount. So that's why till the time I travel into that airline, you cannot recognize that amount as a revenue. So it will be considered as a deferred income or unearned revenue in the books of accounts. Is it clear? The accounting entry is the bank debit and deferred income credit by 3 lakhs. So this is the transaction price. It has two performance obligations. The first one is will occur on the 15th of February. I have to take the passenger from the Karachi and drop on the London airport. And then on 20th of February from the London airport, I have the airline should have to pick that passenger again and drop off at the Karachi airport. So step one is to identify the contract. Yes, we have identified the contract. Step two is to identify the performance obligation. We have identified two performance obligations. Step three is to identify the transaction price. Yes, the transaction price is 3 lakh. Step four is to allocate the transaction price. Now, out of this 300,000, I have to break what will be the price from Karachi to London. Sometimes the prices are equal, sometimes the one-way ticket is expensive and the other way around is cheaper as compared to it depends on the traffic, it depends on the load and depend on days in which you are traveling. Like you can see in the month of December, almost there are vacations and almost all over the world. Then in that period, the traveling prices are high. So there are some peak seasons and some down seasons. So the prices for Karachi to London, London to Karachi might be equal or might be different. So what I have done, I have allocated the transaction price on different performance obligations. Now the fifth step of IFRS 515 is recognize revenue as or when the performance obligation is satisfied. So when the performance obligation is satisfied means when we pick that customer from Karachi to London and the flight is now in the airport, in the air from the Karachi airport, then we have recognized the revenue. That's it. The first entry that we will make on 15th after the flight takeoff will be deferred income debit and revenue credit by 2 lakhs. Now we have earned this amount. And when the passenger will come from London to Karachi back, so on 28th of February, we will make an accounting entry by deferred income debit and revenue credit by 1 lakh. So this is the whole concept. I hope you have understood this point. If you face any confusion, please do ask it immediately. Do you have any question in your mind? Because of the change in the IFRS, there is a change in the treatment of discount all over the world. Now, this is the new treatment for the discounts. So first you need to understand there are two types of discounts. First one is the trade discount and the second one is the settlement discount. I'm just telling you the impact of IFRS 15 on the discount area. The trade discount is given to the customer at the time of the sale transaction. So when the sale is going to occur, whatever discount we gave to the customer at that point will be considered as a trade discount. Settlement discount or cash discount is all about paying the amount early than expected. So whatever we have agreed, for suppose we have agreed to make the payment after 30 days, but I'm paying you in a less time period, like I'm paying you after 10 days or 5 days, then supplier might give you the discount on the early payments. So discounts, settlement discounts are given to the customer because only when you need the payments normally early than agreed. So this concept will only occur in the credit transaction, because in the cash transaction you will have to pay the amount immediately after the transaction. So what are the changes now? Early discount offered by the supplier. That means that you have received a discount. So there might be two situations. You pay early to earn the discount, or do not pay early to do not get the discount. So if you will not pay the discount, you will not receive the discount. The accounting entry will be payables debit and cash debit. But if you get the discount, the accounting entry will be payables debit, cash credit, and discount received credit. If you get the discount, sorry. So the treatment for the discount received is similar as you have previously studied. But the treatment for the discount allowed is now changed. So now what's the changes? What are the changes? The first thing is early settlement discount offered to the customer. So first you need to see whether the customer expect to settle early or the customer not expect to settle early. So it depends on the situation of the customer and the past history, that you know that this customer will always take the discount opportunity, or this customer will never take the discount opportunity. The customer expected to pay the settlement discount early, or the customer not expected. So we are taking, with our assuming right now that the customer is, we expect the customer to pay the amount early. So what they say, that initially when you record that transaction initially after deducting the discount, because you are expecting that the customer will going to avail that discount. So suppose if I have sold the the product for 1 lakh and the discount is 5%, so I should record this transaction at a value of 95%. And suppose the customer has paid the amount early, so the accounting entry will be cash debit, receivables credit. But if the customer has not paid the discount early, then the accounting adjustment will be made through revenue. You can see in these tables that you will not see the word discount allowed now according to IFRS 15. So are you guys getting this point? We are discussing right now the case where the customer expected to settle early. So first you need to record the transaction on net basis. If the customer has paid on time, then it means you do not need to do anything. But if the customer did not honor the discount, then you should have to adjust the difference in the revenue. Is it clear? Yes or no? Yes or no? Okay. Now, what about the customer do not expect to pay settle early? If the customer do not expect to settle early, then you record the transaction on the gross amount. If they pay early, the adjustment will be made through the revenue instead of discount allowed that we made previously. The accounting entry will be revenue debit. And if the customer did not settle the discount when preparing invoice, the accounting entry will be cash debit, receivables credit. Is it clear? So now this is the new treatment of IFRS 15 for discount allowed. So do remember this point that you can expect a question or for discount allowed in your examination. So now moving on towards the next accounting standard, I think we should take a break of 5 minutes as a tea break because we are discussing the theory today. So let's take a 5 minutes tea break, and after that we will start again. 5 minutes break. Then we'll start with IS 10. Okay, welcome back after the break. I think the break is stretched more than 5 minutes. So IS 10 is about the adjusting event and non-adjusting event. Now, what is the concept of IS 10? Suppose if the financial year of the company starts on 1st January and it ends on 31st December, so this date is called the reporting date. Reporting date is the date at which the financial statements are due and you have to make the financial statements at 31st December. But practically it is not possible, in fact, to prepare the financial statement on the reporting date. So normally it will take 2 to 3 months to complete the financial statements practically. So this date is called authorization date. Suppose if the financial year end of 2020 ends on 31st December, so its financial statements will be prepared on, in fact, 31st March 2021. So in 2021, we prepare the financial statements of the previous year. So normally it will take 2 to 3 months for the preparation of financial statements and then auditing and the compliance with different regulations and IFRSs. So it will take time of 2 to 3 months at least to prepare the financial statements and authorize with the board of directors. IS 10 says that IS 10 applies between these two dates, reporting date and authorization date. It says that whatever happened between this period should be reported to the shareholders. So the definition for the events occurring after the reporting date are those events which occur between the reporting date and the date at which financial statements are authorized. So between these two dates, whatever will happen should be reported to the shareholders. So there might be some instances that will happen in 2021 but that will be related to previous year. So if it is related to previous year, then it will be considered as an adjusting event. The adjusting event is actually attached with the previous year. But if there is an event in 2021 but which has nothing to do with the previous year, but the information is so important, then you should include this adjustment as a non-adjusting event. So it will actually appear after the year end. So the treatment for the adjusting event is you need to make the adjustments. Means you need to make an accounting entry to record adjusting events. And for non-adjusting events, you need to disclose the information in notes to the accounts. So all non-adjusting events should be disclosed in notes and all adjusting events must be adjusted in the financial statements. Is it done? So there are few events, there are a list of events that you should memorize are adjusting events, and there are a list of events which are non-adjusting events. I can show you the list. Now these are, I understand this list is available in the study text as well. Now these are adjusting events and these are non-adjusting events. So you just need to learn some of the adjusting and non-adjusting events. So examiner in the examination, examiner might ask you the question that whether this event is an adjusting or this event is non-adjusting. So the list of events, so you only need to memorize those events. But the theme is, let me ask you a question. Suppose on 10th of February 2021, before the authorization of the financial statements, we have identified a fraud that was occurred in December but was found in the month of 10th February. So whether this event is an adjusting or non-adjusting event, what do you think? Whether it is an adjusting event or non-adjusting event? Very good. It's an adjusting event because it is related to the previous year. Now, if assuming if on 12th of February there is a fire in the warehouse and because of this fire most of the stock are lost or damaged. So is it an adjusting or non-adjusting? Very good, because the fire was occurred after the year end. Therefore, it will be considered as a non-adjusting. But do remember this point: if anything happens after the year end, but it affects the going concern of the business, then it will be an adjusting event. If it affects the going concern of the business, like a fire occurred on 12th of February and destroyed the whole inventory system and destroyed the whole building, furniture, business, everything was destroyed because of the fire. And the company will not be in a condition to continue in the future. So in this situation, you can say it affects the going concern. So anything that affects the going concern should be included as an adjusting event. But if there is some loss after the year end which does not affect the going concern, that will be considered as a non-adjusting. Okay, purchase of fixed asset after the year end, because it has nothing to do with the year end. That's why it will be considered as a non-adjusting. But suppose on 10th of February, I found an invoice for the purchase of fixed asset which has not yet been recorded in the books, and the date was mentioned as 15 December, for example, 2020. So we bought the asset on 15 December, but we didn't record that particular transaction in the books of accounts because the invoice was lost, and we found it on the 10th of February 2021. So do you think it's an adjusting or non-adjusting event? It is an adjusting event. Very good. Very good. Now in the first, okay, I have almost covered all the relevant accounting standard that is applicable in our course. So in the first class, there are a few students who asked me about they are having problem in the suspense account topic. I think let's give you a brief introduction of the topic suspense account. Do you think it is needed, or you want the introduction of any other topic? You can just name it and I will give you the brief introduction. Again, I request all the students available online right now to please join the WhatsApp group, so then we can discuss from today onwards on this group. And tomorrow I will share a mock exam on the group. And if you want any handout, or if you need any of my support, or if you want any of the answers of the practice handout that I have provided to you, you can ask me on the WhatsApp group. I will share all the information over there. So it's very important to join the WhatsApp group, and till the examination I will support you guys. And it's highly recommended, if you have attended the whole session, to do to sit in the examination in the month of February. Don't waste this webinar, because if you delayed the exam sitting, you will forget a lot of things. So it's very important, if you are taking this scenario, this webinar on a regular basis, just do the practice of the Kaplan and BBP kit, and ready to sit in the examination in the month of February. So I think the last week of the February is ideal. Just take a date, exam date, and I'm here to support you till your examination date. So in the month of February, I will support you with my full efforts. I will share some mock examination with you, and I will give you the access of Education Hub mock exams if you don't have. So I can in fact I can give you the reasonable assurance that you will pass this examination. Yes, I will provide you the answers. You just ask me, but the main condition is that if you have solved that handout, if you have solved that handout, you just share it with me. I will give you the answers. The suspense account is about debit and credit. In fact, when the debit and credit is not equal, suspense account will be opened. So the question is, when suspense account will be opened? When the debit and credit are not equal. Yeah, it's enough to practice Kaplan and BPP, both the kits at once, but when you are attempting the examination kit for the first time, please do mark the challenging questions that you faced, and you have to revise that challenging questions till the examination date. Where suspense account will be open? So the answer is where the trial balance will be short. And what will be the correction? How we can correct the suspense account? So the answer is the correction will always be made on the opposite side. Let me give you an example. Suppose the transaction is cash debit sales credit by 10,000. So that is the original entry of the transaction. So suppose we have wrongly recorded this transaction by debiting the cash and crediting the sales account by 12,000. So the first criteria is whether the debit and credit equal. The answer is no. Then we will open a suspense account where the trial balance is short. So you can clearly see here the trial balance is short on the debit side. So we will open a suspense account on the debit side by 2000. So suspense account will always be open on the area on the side which is short in the trial balance. And at the time of correction, you should have to make the accounting entry on the opposite side. So initially we have opened the suspense account on the debit side, and at the time of correction, it will come on the credit side. Suspense account will be credited by 2000 and sales will be debited by 2000. Because we had made a mistake in the sales account, so only the sales will be used at the time of the correction. WhatsApp contact detail is available here. I'm sharing with you again. That's my WhatsApp number. So I request all the students, please to join our WhatsApp group so that we can discuss all the related concepts over there. So that's the brief introduction of the WhatsApp group. Thank you so much for joining this webinar, and I wanted to thank ACCA team members who supported me always and who provide me this opportunity to interact with the students almost all over the world. So I'm here and available for the month of February. After this webinar, my WhatsApp number is here. Whatever problem that you are facing in this paper, you can discuss with me on the WhatsApp. I will share the mock examination tomorrow. Believe me, if you attempt all the 3 to 4 mock exams, you will definitely pass this exam. And I hope this support of ACCA and me provides you some benefits. It might improve your concepts, and I have tried my best. Now, we always open the suspense accounts the side where the errors were made. The answer is no. We always open the suspense account where the balance in the trial balance is lesser. Like if you see in my example, the error was made on the credit side, but the suspense account was open on the debit side. The suspense account has nothing to do with the error. It will be open only when the trial balance is imbalance. So to fill the shorter side, you open the suspense account, and after that, you will reverse the suspense account at the time of the correction. So thank you so much. Take care of yourself. Please give your valuable feedback to the ACC team so that these type of sessions will be delivered to the future students on a regular basis. If you think that these sessions are useful and valuable, please give your valuable feedback. Thank you so much. Do take care of yourself. Allah Hafiz.